Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 132. And in this episode, we are reviewing the performance of the global markets during the 44th week of 2024. And that is from Monday, the 28th of October to Friday, the 1st of November. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where job creation in the month of October slowed down to its weakest pace since December 2020 as the impact of hurricanes in the southeast and a significant labor strike at Boeing dented the employment picture in the United States. On Friday, the Bureau of Labor Statistics reported that Nonfarm payrolls increased by just 12,000 new jobs in October, and this was down sharply from September and also fell below the Dow Jones estimate for 100,000 new jobs. The unemployment rate, however, held steady at 4.1%, which was in line with market expectations. In contrast to non-farm payrolls, and despite the storm season in the southeast and major labor disputes, ADP reported on Wednesday that private sector job creation in the month of October expanded at its fastest pace in more than a year, that is since July 2023. ADP, which is a payrolls processing company, reported that private sector companies hired 233,000 new workers in the month of October, which was better than the upwardly revised number of 159,000 workers in September and far ahead of the Dow Jones estimate for 113,000 workers. Staying in the United States, according to a report released by the Commerce Department on Thursday, inflation increased slightly in the month of September, but remained within touching range of the Federal Reserve's target rate of 2%, a level it has not achieved since February 2021. The Personal Consumption Expenditures Price Index, which is the Fed's favorite measure of inflation, increased by 0.2% for the month, with the annual rate of inflation coming in at 2.1% as both rates came out in line with market expectations. However, excluding food and energy prices, the core inflation reading was recorded at 2.7%, which was 0.1 percentage points higher than the forecast rate. One last data point from the United States this past week shows that the U.S. economy posted another solid period of growth in the third quarter of 2024, propelled by stronger consumer spending that has defied expectations for an economic slowdown. According to a Commerce Department report released on Wednesday, the gross domestic product, which is a measure of all the goods and services produced in the U.S. economy, this increased at an annualized rate of 2.8%. The U.S. economy accelerated at a pace of 3% in the second quarter of 2024, and economists surveyed by Dow Jones were expecting an increase of at least 3.1%. The report confirms that the U.S. economy has continued to grow despite elevated interest rates and concerns that fiscal and monetary stimulus would not be sufficient to sustain economic growth. However, resilient consumer spending, which accounts for about 2/3 of U.S. economic activity, has helped to keep the economy moving, in addition to government spending that has pushed the budget deficit to more than $1.8 trillion in the current fiscal year 2024. And over to the European Union, where, according to flash figures published by Eurostat on Wednesday, the Eurozone economy grew by 0.4% in the third quarter of 2024. That was higher than market expectations for a growth of 0.2% and follows an expansion of 0.3% in the second quarter of this year. Germany, which is the Eurozone's largest economy, recorded a surprise growth of 0.2% in the third quarter of 2024 and in the process managed to avoid an economic recession as it continues to struggle with a downturn in its key manufacturing sector. For your information, a technical recession is marked by 2 consecutive quarters of economic contraction. But even as the country avoided a technical recession in the third quarter, inflation in Germany surged to 2.4% in the month of October, which was above the European Central Bank's target rate of 2%. Analysts polled by Reuters had expected inflation to come in at 2.1% in October, after it had dropped to 1.8% in September. Back in the United States, on Wall Street this past week, the stock market rallied on Friday to kick off the month of November on a high note, with traders looking past the disappointing jobs report for October. Mega tech stocks are still the tail wagging the dog, as Amazon led the technology stocks into the green as it rose by 6.2%, driven mainly by a strong performance in its cloud and advertising businesses that propelled its earnings above Wall Street's expectations. The Dow Jones Industrial Average gained by 288 points to close the day at 42,052, whilst the S&P 500 advanced by 0.4% to end the session at 5,728, and the Nasdaq Composite rose by 0.8% to eventually settle at 18,239. In the U.S. government bond market, the yield on the 10-year Treasury bond rose on Friday as traders downplayed October's jobs report that showed a meager growth of just 12,000 new jobs vis-a-vis market expectations for 100,000 new jobs. This past week, investors were inundated with a series of key economic reports ranging from the October jobs report to the Fed's preferred measure of inflation, as well as the gross domestic product for the third quarter of 2024. In response to all these data, the yield on the benchmark 10-year Treasury bond jumped nearly 10 basis points to 4.38%, whilst the yield on the policy-sensitive 2-year Treasury note was higher by 5 basis points to perch at 4.21%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil rose slightly on Friday, and this was on the back of reports that Iran was preparing a retaliatory strike against Israel in the coming days. Israel's intelligence suggests that Iran is preparing to attack Israel from Iraq in the next few days. In response to the foregoing, the price of Brent crude gained 29 cents to close at $73.10 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, added 23 cents to settle at $69.49 per barrel. For the week, both benchmarks were down by more than 3%, after gaining about 4% the previous week. For your information, according to data from the U.S. Energy Information Administration, Iran, which is a member of the Organization of Petroleum Exporting Countries, produced about 4 million barrels of crude oil per day in 2023. In the precious metals market, the price of gold edged lower on Friday and was mainly pressured by a stronger US dollar and higher treasury yields. However, an extremely weak US jobs report prompted investors to increase their bets that the Federal Reserve will cut interest rates at its policy meeting this coming week, which helped to limit the downside for bullion. Economists are projecting a 100% chance that the Fed will cut interest rates by 25 basis points. The price of gold is normally influenced by the US dollar and treasury yields. However, the current high market price for gold is partly driven by uncertainty about the US presidential elections, as well as the anticipated rate cuts by the Federal Reserve, plus the broader geopolitical risks in the Ukraine and the Middle East. The price of spot gold hit a record high of $2,790 on Thursday, before profit-taking saw the price fall by about 1.5% to eventually come to a close at $2,736 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country. Overall inflation declined from 3.6% in September to a 17-year low of 2.7% in October. This decline in inflation was mainly attributed to lower fuel and food prices, as fuel inflation declined from 1.7% in September to 1.1% in October. Whilst food inflation declined from 5.1% in September to 4.3% in October, mainly due to a decline in vegetable prices. Meanwhile, the core rate of inflation, otherwise known as non-food, non-fuel inflation, this declined marginally from 3.4% in September to 3.3% in October, reflecting a general stability in prices for the common basket of goods and services. In the domestic foreign exchange market, during the past week, the Kenya shilling remained flat versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.20. Meanwhile, the sterling pound was priced at 167.32, and the euro was valued at 140.18. And on the regional front, one Kenyan shilling was changing hands for 28.34 Ugandan shillings and 21.05 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.49. The dollar-shilling exchange rate has now been trading at the same level of 129.20 for the past 4 to 5 weeks. Now, this is not normal price action. Even when a currency is stable, it normally fluctuates within a narrow range. But what we are seeing now, where the dollar is fixed at 129.20, this is a clear signal that the market is being manipulated. The outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by $90 million to $8.586 billion, which is equivalent to 4.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is a rate that banks lend to each other on an overnight basis, this increased marginally by 13 basis points, up from 11.97% that was recorded the previous week to 12.10%. And in terms of volume, the average value that was traded in the interbank market decreased from 44.4 billion shillings the previous week to 33.6 billion shillings. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 39.5 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 31st of October, and the central bank received bids totaling 62.16 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 259%. The central bank ended up accepting only 28.13 billion shillings, and the results of the auction were as follows. The 91-day rate fell by about 46 basis points to average out at 13.96%, whilst the 182-day rate dropped by about 62 basis points to close out at 14.52%, and the 364-day rate declined by 50 basis points to eventually settle at 14.96%. In the international market, during the month of October, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 12-year 2019 Eurobond increasing the most by about 30 basis points from 9.6% recorded at the end of September to 9.9% recorded at the end of October 2024. At the Nairobi Securities Exchange, during the month of October, the equities market was on an upward trajectory, with the NSE 10 and the NSE 25 gaining the most by 10.1% each, whilst the NASI and the NSE 20 gained by 9.8% and 7.3% respectively. The positive performance in the equities market was driven by gains recorded by large cap stocks such as East African Breweries, Bamburi Cement, and Safaricom, which increased in value by 18.3%, 11.9%, and 11.7% respectively. And in related news, Kenya Power has resumed paying dividends, ending a 6-year drought for shareholders after the company posted a net profit of 30 billion shillings for the year ended June 2024, as it recovered from a net loss of about 3.2 billion shillings that was posted the previous year. The power distribution company said that it would pay out a dividend of 70 cents per share for a cumulative total payout of 1.3 billion shillings. The resumption of profits and dividend payments sparked a rally in Kenya Power shares at the Nairobi Securities Exchange, as they gained by about 50% for the day to eventually close at 5 shillings and 24 cents per share. Up next is our topical issue, and this week we are looking at the IMF's approval of additional funding for Kenya. On Thursday, the International Monetary Fund approved a fresh disbursement to Kenya for $606 million, which is equivalent to about 78 billion shillings, as it called for new tax reform measures to address the issue of rising debt repayments. Even after the Gen Z demonstrations earlier this year that led to the withdrawal of the finance bill for 2024, it looks like Kenyans will still have to contend with new and higher taxes after the International Monetary Fund signaled the need for the country to raise additional revenue as a condition to continue accessing loan facilities from the Washington, D.C.-based lender. The IMF noted that in the year to June 2024, which was prior to the withdrawal of the contentious finance bill, Kenya still underperformed on revenue collections, which in turn put the Treasury into an extremely tight financial position. Kenya's mounting national debt has seen it commit more than half of its annual tax revenue collections into repaying this debt, with the bulk of the balance going to finance recurrent expenditure, which leaves little to no funding for development projects. The approval by the IMF board is crucial as it paves the way for the Kenyan government to access funding that is desperately required to help the country navigate its current liquidity challenges, which are the result of an unsustainable debt and the attendant debt servicing obligations. In addition to the above, the International Monetary Fund has raised concerns about Kenya's plans to borrow $1.5 billion from the United Arab Emirates. The facility from the Emirates has a moratorium of 7 years, but comes with an interest rate of 8.25% and a repayment period of another 7 years. The fund reckons that the debt from the Emirates is costly and could derail Kenya's debt management plan, which requires the country to avoid commercial loans in favor of longer-dated concessional loans, which are cheaper. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, whether you think you can or you think you can't, either way, you're right. Think about it. Thank you, and God bless.